In my previous video, we talked about the general rules regarding assets, liability, and capital. So today we'll be solving some examples to help us understand the rules. So let us look at this example, the Douglas example. It says Douglas has the following transactions during January. 1. Introduce 5,000 cash as capital. So it says Douglas introduced 5,000 cash as capital. So let us identify the accounts related to this example or to this transaction: cash and capital. So let's draw the T account for cash. First, what is cash? Cash is an asset. It's what the Douglas has put 5,000 cash into the business. So now the 5,000 belongs to the business. So cash is an asset. And now let's state the rules regarding an asset. Per the accounting rules, it says asset increases at the debit side. So asset increases at the debit side. Asset increases at the debit side. At the debit side. So asset increases and asset decreases at the credit side. And I said with the T account, the left side of the T account is called debit. So this side is debit, the debit side. And the right side is the credit side, this side. So the rule says asset increases at the debit side. So Douglas has introduced 5,000 into the business, has introduced 5,000 cash into the business. So initially, the business had zero cash, nothing. The business had no cash, and now Douglas has put 5,000. So it means the cash of the business will increase. So we said it increases at the debit side. So debit side, it increases here. So we write 5,000 here. So we write 5,000. And it increases as a result of capital. So in the name of capital. Now let's tackle the second account, which is capital. I believe you all know the meaning of capital. Capital is the money the owner has invested into the business. So as you said, the left side of the T account is the debit. So this side here is the debit side, and this is the credit side. The right side of the T account is the credit side. And now let's state the rules, the accounting rules regarding capital. We said with capital increases at the credit side, and decreases at the debit side. And the question says Douglas introduced 5,000 cash as capital. So it means capital is the amount of money the owner has put into the business. So initially there was zero capital. The owner there was zero capital, and now the owner has put 5,000 cash into the business. So it means the capital has increased from 0 to 5,000, and we said per the accounting rules, when capital increases, what do? We credit it. So now let's credit it. So we write it here, and it increased by 5,000 in the name of cash. In the name of cash. So now we are done with question 1. We can see that with cash, which is an asset, we debited it, and capital, we credited it. So if you debit one account, it means you credit the other one. Now let's see if you can answer question 2. It said purchased goods on credit from Richard worth 2,000. So let's now identify the accounts involved in this transaction. It said purchase goods on credit from Richard. So purchased. So we know we need to open an account for purchases. And Richard. And here is the keyword. We purchased goods on credit, meaning we didn't pay. So we purchased goods on credit from Richard. So Richard is our supplier. Richard supplied us goods on credit. We didn't pay for the goods Richard supplied. So now let's draw the T account for purchases. And as we know that the left side of the T account is the debit side, and the right side of the T account is the credit side. So purchase goods on. Now let's state the rules. Purchases increase, or purchase increase at the debit side, and decreases at the credit side. So always remember the rules. As a beginner, try and state the rules. So we said purchases increase at the credit side. So the business purchases has increased. It said purchases increased, purchase goods on credit. So the purchases of the business has increased, and with the rules it says purchases increase at the debit side, and this is the debit side, the left side of the T account. So it increased by 2,000. And as a result of we buying, or Douglas business buying goods on credit from Richard, who is a supplier. So we will put Richard. He's a supplier. Then we will open an account for Richard. Richard is a supplier. So let's ask ourselves, is Richard an asset, a liability, or capital? Richard is a liability. How did we define liability? We said liability means you do owe someone and you have an obligation to pay the person back. And the question says we bought goods on credit from Richard. So we have an obligation to pay Richard. So Richard is a liability. Richard is a liability. So what is the rule surrounding liability? We said liability increases at the credit side and decreases at the debit side. Liability increases at the credit side and decreases at the debit side. So Richard, we purchased goods on credit from Richard. So our liability now the people we are owing has increased. Richard, first, initially when we started, we had zero liability. We weren't owing anyone, and now we are owing. So then people we are owing has increased, and it increased by 2,000. We purchased goods on credit from Richard. We owe 2,000. So per the rules, we said liability increases at the credit side, and we know the credit side is the right side of the T account. Here is the right side. So we credit liability with 2,000. In the name of purchases, our liability increased because of purchases. So this is the trick, if you debit one account, it means you credit the other one. From this example, you can see we debited purchases. Here's it. We debited purchases. And from here, and with Richard being a supplier, we credited purchases. So if you debit one, you credit the other one. So I think this is all for today. Tomorrow we will continue with more examples.